Hello, you guys. This is part 2 of IB Business Management 3.4. Now we're going to be doing the only part, which is depreciation. So let us begin. So what is depreciation? What is the definition of depreciation? Depreciation is defined as the decrease in the fixed value of an asset over time. So it's the decrease in fixed value of an asset over time. Why does an asset depreciate? So what are the reasons for its depreciation? First, wear and tear, meaning that the repeated use of non-current assets causes them to fall in value and more money is needed to maintain them. So basically, non-current assets, for example, what do we have? We have machinery as a non-current asset. So for example, the more you use the machine, the more it's gonna like need repairs, it's gonna be needing to be checked more often, right? It's going to need mechanic, so that's why it's going to end up depreciating in value because it's not the same as when you first begin to use it, it's not as fresh. The second reason is obsolescence, meaning that existing non-current assets fall in value when there's new and improved versions. Like, for example, let's say there's a new machinery that produces more output in a smaller amount of time, right? Or improved versions are introduced in the market. Okay, so the one you're using is too slow relative to your competitors, and it's not as useful, and it's just outdated at that point. Okay, so obsolescence means it's like another word for outdated. Okay. So now calculating depreciation. So the first way you calculate it is straight line depreciation. It's a method that spreads out the cost of an asset equally over a lifetime by deducting a constant amount of depreciation over the asset's value per annum, right? So per year. So basically, in year zero, the annual depreciation expense is zero because it didn't start depreciating, and the net book value is X, okay? But then the depreciation in year one is Y. So what you do is that the value of the assets, basically its original value minus depreciation in year one. Okay. Then in year two, the depreciation becomes double, right? Okay. So then you do depreciation in year two. So why is depreciation in year two? And then you have 3y, so depreciates even more. So then the net book value is minus 3y. So depreciation in year three. Okay. So advantages of the simple line method is that it's simple to calculate as it's a predictable expense that is spread over a number of years. And it's more suitable for less expensive items that can be written off within the asset's estimated useful life. Okay, because look, its original cost, so the cost of the machinery or like non-current assets, its residual value, and expected useful life of assets. So how many years are going to use it? 4 years, 5 years, okay. And then residual value and the original cost. So that's basically the annual depreciation per year. This annual depreciation will be placed here. So basically, let's say the annual depreciation is 1,000. Here it becomes 2,000. Here it becomes 3,000. Okay, basically. So it's simple to calculate. Yes, it's a predictable expense. It's more suitable for less expensive items. Okay. And then disadvantages. It's not suitable for expensive assets such as machinery. Okay, so keep in mind, simple is for suitable for non-expensive assets, let's say. Okay. Such as machinery does not cater for the loss in efficiency or an increase in repair expenses over the useful life of an asset, like I previously mentioned about the machinery part. So yeah, it's not that suitable, it's not that predictable because like the first year it'll be working at a certain rate, but then at the third year it's going to be working at a pretty much slower rate. Okay. And it can inflate the value of some assets which may have lost the greatest amount of value in their first or second year, right? That's what I just said. It does not take into account the fast-changing technological environment that may render certain fixed assets obsolete very quickly. Because, like I previously mentioned, that these days, technology is really, really advanced. Companies are always coming up with new things. So, this is important to keep in mind. Now you have the second method, which is new. This is not put in any past papers. So basically, it calculates the depreciation of the value of an asset based on usage. So based on how much it's used, okay? Not the amount of time it's used, but how much it's used, the amount of times it's used. In this method, depreciation will be higher when there is a greater volume of activity during the year. One asset is used a lot and lower during that time where asset used less. Sometimes in some businesses are seasonal. For example, when they produce, let's say, something for skis, they're producing stuff for winter, let's say, they're going to be using the machinery a lot in in the winter time, but in summertime they won't be using it as much, let's say. Okay, so it depends. So it's going to be depreciating more during the winter rather than in the summer. Okay, and now we're going to be discussing the formula. So basically, the formula is cost basis. So you have basically cost basis of asset minus salvage value over estimate total units to be produced over estimated life times the actual units produced. Okay, so this is the depreciation expense. Okay, and then you have for the units of production rate, you have cost base of asset minus salvage value over estimated total units to be produced over the useful life. So this is all units of production rate. And then units of production rate times actual units produced equals depreciation expense. Okay. So these two, so basically basically units of production rate times the actual units produced is depreciation expense. Now the advantages of this method and disadvantages, and that's it, we're almost done. So advantages is basically as depreciation expense is directly related to the wear and tear of this asset. This method writes down an asset based on its usage opposed to time. So basically it's not about the time, it's about how much it's used. This is a more accurate reflection about the declining physical value of an asset, especially the assets like if it's a machinery. This is very much more accurate, right? So it's a more accurate reflection. Accurately matches revenue and expenses. Revenues generated are matched to expenses when producing financial statements, hence providing a more realistic view of what's taking place in the business, right? So basically how much they're producing, meaning the cost of the variable cost, right? It also takes the variable cost into account because basically the raw materials being taken to account. So basically, you can talk about a raw material variable cost, right? So this is why it's really matching to the expenses on the financial statements, just because the amount of output you're producing is not only using up the machinery, it's not only depreciating the machinery, but also costing the business variable costs, raw material. Now, disadvantages. This method is not allowed for tax purposes. It can be used when a business computes its tax returns at the end of the year. Oh, sorry, it cannot be used when a business computes its taxes returns at the end of the year. Okay. It can be complicated to compare the units of depreciation. Also, measuring output can be tricky, and depreciation expenses must be calculated each period, right? It's also only useful for manufacturers or producers. It makes little sense to tie depreciation to asset usage if the business does not manufacture the product, right? So sometimes it doesn't manufacture the product, sometimes it outsources, right? So this is really it. Thanks so much, guys, for watching, and I hope you like this video. Bye bye.